Welcome to 3 and 3. My name is Jason Weaver. Today we're going to be talking about the stay-at-home bubble, economic slowdown, and the eventual economic recovery. So the stay-at-home bubble. The COVID pandemic lockdowns created demand for many stay-at-home companies. And as the world reopens, stay-at-home companies now have excess inventory. Some of the biggest benefactors during COVID were the stay-at-home stocks, like Peloton, Chegg, Zillow, Teladoc, Zoom, and Roku. And you can see the performance was up in the 100 to 400% actual range. But now as we look into 2021 and 2022, people are out doing activities and they're not using Zoom as much or their Pelotons as much or Chegg. And so those stocks are underperforming because we're trading at such high multiples, and now those multiples are coming down and their growth rates are coming down and their earnings are coming down, and of course the stock prices are coming down with that also. Economic slowdown. The Fed has begun raising interest rates this year to tame prices and slow the economy. So characteristics of a slowdown can be higher unemployment. We haven't seen that yet. Higher interest rates. We've definitely seen rates now move up to about 4% on a one-year treasury bill. The housing market slowdown, we're seeing that also here currently, and new business activity order slowdown. And we're definitely seeing that in different parts of the economy. So the way this works is when you see the economic slowdown, you eventually start to see the recovery. So this chart illustrates the different economic conditions you'll experience in the actual growth and then eventual slowdown. And what we don't know is, will this be a soft landing or a hard landing? But as you look at the economic indicators, we're currently right now at the housing slowdown. The next actual slowdown will be financial, and then we'll see if this is a soft landing or a hard landing. Most economists right now are projecting this to be a soft landing, and potentially we're having a recession in the first quarter or second quarter of 2023. Economic recovery. Typically, the housing market recovers first, and then new orders will pick up, corporate profits will eventually grow, and employment will get tight again. So looking back to previous economic slowdowns, you can see back in 2000 that earnings per share of companies typically peak right around as the economy is starting to roll over. But stock prices actually fall before that earnings peak. Going into 2008, you can see the same scenario. Earnings peaked, and the stock market actually was anticipating those earnings had peaked and was starting to fall. Currently, we haven't seen potentially peak earnings yet, but the stock market is falling in anticipation that earnings are going to be compressed by rising interest rates and falling margins. The economic clock. As you look at the economic clock, there's various indicators on the outside of the clock. And the inside of that is typically how we're feeling about things. And then this is the type of action we should be taking based upon where we're at in the economic clock. So as the Fed is raising interest rates, you can see typically we move from greed to euphoria, which is 12 o'clock. But right about then, you start to see commodity prices start to fall. And now as an investor, you start wishing and hoping your portfolio will do better in the future. But it's actually not. It starts to go into now profits start to decrease, and now we become nervous. Inflation starts to fall, and then we move to, again, capital expenditures actually starting to fall. The Fed's job then is to avoid right around 5 and 6 o'clock and move us from 4 and 5 over to 8. And that's the economic recovery that we're talking about. So we're probably somewhere in between that 12 and 1 o'clock phase as we look at the economy, going in from 22 to, again, the first quarter, second quarter of 2023.